organizers, we know that it's very difficult to organize things like this. So, we at Rete MMT, I'm an activist, I'm an Italian activist. No, I'm not an economist, so I'll keep it simple today. I've written a paper, which is this one, about the role and limits of the banking system. If you want, there are a bunch of them. I will keep it simple just to remind a couple of things. And I think that one of those is very important today because I've heard many of you talking about endogenous market, right? And I would like to clarify one thing. I'm sure many of you already know, but I want to be sure that it's clear that MMT is not an endogenous money-based theory. It includes endogenous money approach. Of course, Randall Ray has talked about endogenous money many times. But MMT is not an endogenous money-based theory. And to explain that a little further, I need to define one concept, which is the concept of net financial assets. I'm sure that most of you already know what I mean, but I want to be sure you all understand. So, net financial assets are the difference for any accounting entity. They are the difference between the financial assets, not all the assets, just financial assets, and the financial liabilities. The difference between the two is the net financial assets you have. And why is this important? And why is net financial assets the unit of measurement that Warren Mosler uses in one of his most famous papers, which is Full Employment and Price Stability? Why doesn't it talk about money or deposits? It talks about net financial assets. They are so important because they are the ultimate mean of payment in a monetary system. Think about it, it's quite simple. Whenever you pay someone to buy a real good or service or labor, you spend net financial assets because you are spending financial assets without increasing your liabilities. Or suppose you make a loan and then, so you borrow money and then pay to buy a real good. In that case, what you end up with is increased liabilities and same assets than before, same financial assets. Also in that case, your net financial assets decrease. So net financial assets are the ultimate mean of payment. What bank credit does not do on its own is to increase net financial assets, because think about it, when you borrow some money, you are, in the moment you borrow those money, you are increasing your bank account, so your financial assets increase, but also your debt to the bank increases, so also your financial liabilities increase by the same amount. So your net, at the end, your net financial assets don't change. And so what does not change is your net financial position, is your possession of means of payment to use in the monetary system to make final payments, to buy goods and services.
If you don't mean commercial banks.
Yes, commercial banks. But also, if the central bank lends some money to banks, also the net financial position of the bank doesn't change. Because also for the bank, there are more assets, reserves, but more liabilities. The liability toward the central bank. In fact, it is a loan. They are not giving out money for free. It's a loan. It's not a free lunch. So net financial assets are so important in the monetary system, and that's why they are the only thing you can use to pay taxes. These are taxes. When the state imposes the obligation of taxation to all of us, it forces us to search, to look for net financial assets to pay those taxes. When you pay taxes, your financial assets decrease, your financial liabilities don't change, so your net financial assets decrease. So you're forced to have net financial assets to pay taxes. But for the whole private sector, for the private sector as a unique accounting entity, the only source of net financial assets is the monopolist of currencies, the state. Oh, by the way, I'm talking about the private sector as the consolidation of all economic agents that use a particular currency, not the national sector, the national private sector. All the firms and people who use a certain currency around the world. For that sector, the only source of currency-denominated net financial assets is the state. And that currency-denominated net financial assets is what is needed to pay the taxes. So, what banks cannot do is to increase the ability of the private sector as a whole to pay taxes. And this has a very direct implication about unemployment. You see this image here. At each one of these pairs of people is composed by a subject, the white one, which wants to sell his labor force, in exchange for net financial assets. Why does it desire net financial assets? To pay taxes or save. The other one, the red one, is someone which is willing to spend, to decrease its share of net financial assets to buy that labor or to buy those goods and services. There could be someone in the economy, that guy in the corner, which wants to buy net financial assets by selling goods and services or labor, but no one else is willing to spend, to decrease its net financial position to buy that goods and services or labor. In that case, that guy remains unemployed. But who is the only source of net financial assets for that guy? It's the monopolist of the currency, it's the state. There's no other internal source of net financial assets. And why is simple, because other subjects, the red ones, want to save that share of net financial assets, which otherwise would have been given to the unemployed. So, if unemployment is caused by the lack of net financial assets in the private sector, and the state is the monopolist of net financial assets for the private sector, then unemployment is the proof that the public deficit is too low. Public deficit is the operation through which the state spends net financial assets into existence. Okay, that was my point. It was simple and short, as promised. Thank you. You have some questions.
Thank you. Very enlightening. And what you just demonstrate is a core problem of the European Monetary Union.
Of course.
Of course, yes. I don't have to elaborate on that because the national state don't have the possibility to provide these net financial assets. That's one thing. And if you add the foreign sector, you complicate it even further. Because then you have Germany accumulating, and they are not always willing to provide financial aid. So I think this really goes to the core. And from the American point of view, well, the situation is different. From the member state of the monetary union, yeah.
Actually, member states of the monetary union, from this standpoint, are as all of us. They must get net financial assets from somewhere else.
And therefore the ECB has reacted. They have understood at last this problem at a very late stage.
And let me say that this is, as also he said, this is a problem about quantitative easing. Why didn't it work? Because it's not adding net financial assets to any accounting entity, nor to banks, nor to privates. And banks can lend only, let me state this other thing, banks can lend to someone only if there's someone who wants to borrow. And someone wants to borrow because it wants to spend. And it can spend if it has net financial assets in the first place. If it does not, borrowing some liquidity won't happen. Yes?
How do you mean that? If I have €0 and I borrow $1 million from a bank,
Yeah.
then,
Then you spend those, yeah.
Yeah.
You have €0, you have zero net financial position, you borrow 1 million from a bank, then you spend that million, you have minus 1 million net financial position, which is a risky,
But I understand, right? So you started by saying that you need net financial assets to spend, but I don't. I can borrow and spend.
You have net financial, well, in that case, you will have net financial liabilities. You're going negative
Yeah.
on your net financial assets.
So
Yes.
the descriptively correct thing to say is that the final means of settlement is bank deposits in almost all cases. It's not net financial assets.
That's the form it assumes. That's the form it assumes.
Yeah.
But from an accounting standpoint, they are always net financial assets,
No, from an
whichever
accounting
form
standpoint-
they assume,
From an accounting standpoint, I can start with zero net financial assets. I can
and go negative.
borrow and then spend. And
Yeah, in
you
that
can
case,
call
you're
it-
going
you can
negative,
call that
negative.
negative net financial assets, but
Of course.
what I do is I use bank deposits. to
But when you
spend.
borrow, I'll come to you. When you borrow, you have to provide some collateral. Okay, that's the point.
No, not necessarily.
Where?
If you have
Where
a good
can I
business,
go without
if you have a
providing
good business
collateral?
plan, you can get a loan. If you have a good business plan, then your future profit is collateral.
Yeah, your future profit is the collateral. Yeah.
So my point is, you
But
don't-
if you don't get that future profit, then you're not able to pay back the loan. And in that case, your negative share of net financial assets, your investment, your negative share of net financial assets, passes to the bank, which registers a loss in its
But-
account.
But now you're assuming a scenario where I would fail. But if I don't fail, and the job of the bank is to make a
That means
decision
if you
between.
don't fail, that means that you're paying back. Sorry. Well, that means two things. First, it means that other people are selling you their net financial assets to replenish your negative share. Okay?
No,
Why not?
the bank is issuing liability on itself to finance my business. That is
But-
credit creation.
Yes, but at the moment you make the investment, you buy the machine. You're spending a big amount of net financial assets. You're going negative, suppose. Individually, yes. Individually, I mean individually. You are individually going negative.
The money is circulating.
Yeah. And then, in the future, people buy your goods and services, which you create with those investments. And in that moment, they replenish your negative share of net financial assets. You go back to zero, and you're able, in the meanwhile, to pay back your debt with the bank. And in that way, it all turns to zero, except for the interest rate.
So it's bank finance. Just one sentence, right? So it's bank finance at the beginning that makes possible the expansion of economic activity and employment. It is not net financial assets, I think.
Yeah.
But we should discuss it more in the break.
Yeah, and I'm on your side. Would you agree that growing private debt would contribute to aggregate demand? Yes or no?
Of course. But as, yeah,
So, how do you integrate it into your theory?
it's written not by me, but by Warren Mosler with Matthew Forstater in a paper which is called,
I think
that,
it's flawed. The theory is flawed at its point.
no, there are, that paper was written to respond to the criticism coming from the circuit approach. And the paper shows that there are actually two circuits. One is a horizontal circuit, which is endogenous money. That of course is a share of the aggregate demand. And the other circuit is the vertical money. So the money coming from the state with public spending, circulating into the economy, and then coming back to the state for the payment of taxes. The thing is...
I think you have to take time into account. So if you have a credit bubble that contributes to aggregate demand, so in the first place, then of course you have a boom. That's what we're seeing. That's capitalism. That's real life.
But that boom, that finance,
and then it collapses.
Yes.
But you don't need net financial assets. You need to feed the bubble.
Yeah, but every financial bubble is backed by something. It's backed by something. There must be something.
Maybe some expectations. That's what drives the.
But what happens? Okay, but let's do it like this.
Without any real underlying.
What happens? Why does the bubble? Collapse? Because there's no backing.
No, because you can't indefinitely extend private debt.
But why? Why? Tell me why.
Because at some point people have to buy it back, or they recognize that the real reason is that banks at a certain point won't lend anymore because they
feel
they
that
might go bust if
yes.
They leverage and the credit one.
And the reason that and the reason why the bank
That's about the liquidity preference, right?
Exactly.
That's the core of the case.
the reason why the bank fails is that someone doesn't pay back the loan, right? Is that right? If someone doesn't pay back the loan, it's because it doesn't have the financial asset incoming to pay back. If the financial assets flow was there, the bank wouldn't fail. If the government injected the net financial assets needed to pay all the financial bubbles of the world, no financial burst there would ever be.
That's a different point.
It's the same. It's the same.
We need a break.
Yeah.
Thank you very much.